Hey, welcome to day number 7 of 10 days of money momentum. Let's just make sure everyone is in the house. Got on just a touch late. We were running a little late, but let's just see. I want to make sure that we're all live. And looks like we are. All right. Pat is in the house. Dara's in the house. Awesome. So good to have you guys here. We've been having fun. Well, I don't know about you guys, but I've been having fun. I've been having a ton of fun with these 10 days, having conversations. Mark, man, it's good to have you back again, my friend. And so today we're going to talk about discipline. Well, we're going to talk about rules. Okay, we're going to have some fun today because I think now we're going to start. We spent a bit of time setting some groundwork, setting some foundation for moving the money needle, for turn around and saying, what do we need to do to have the right mindset, to have the right attitude, to have the right fundamentals, foundation from which to build our money game on, to build our wealth, to build our affluence. Remember, the idea here is this, is that many entrepreneurs are running on a treadmill. Many entrepreneurs are what I call treadmill entrepreneurs. They're running like crazy, and they think that the best way to scale their business, their best way to scale their money, their best way to create wealth is to run faster, run harder, run more, run longer. Until their health suffers, until their relationship suffers, until there's a breakdown, until there's burnout. And some of you might have even been there before. I know I was there, okay? And it doesn't need to be that way. But we need to run the business a certain way. We need to think about our business a certain way, but we also need to think about our money. Too often, we think about our business and our money as separate things, but they can't be. They're integrated. Remember, we talked about this idea of work-life harmony. Well, harmony needs to be in all levels, in all domains of your life. There needs to be some harmony. Now, there's always going to be some disharmony. There's always going to be some tension in some areas. But this is where we grow from. This is where we go from and everything. So this is where we now I want to start to talk a little bit about some of the things that you can be looking at from the standpoint of money decisions, money choices, investments, and things like that. In fact, we're going to talk a bit about why do people lose money. My buddy Evan is on the line with me, man. And so, why are people losing money? Let me give you an idea. Some of you know that in 2005, I got into an investment. That turned out to be a Ponzi scheme. Wiped out 1/3 of everything I owned. Well into the 7 figures. Between me and 2 other buddies, we lost over $4.5 million. Okay? Bad investment. Now, what happened? Okay? What happened to do that? Now, for me, I meet this guy, just so you understand how some of this stuff can happen. Because for me, I had the shame, I had the embarrassment, I had the bitterness, I had the resentment, the guilt. I didn't want to talk about it because I'm a financial guy. I'm a CPA. I'm actually the guy that they hire to put people like this guy in jail. And in fact, I testified in the grand jury and to put him in jail. But point being is that I got taken. But there was reasons for it. And I want to give you some of those reasons so you don't get taken or you don't make bad investment. We're going to talk about my 8 rules of investing today. We're going to talk about why, people lose money and what it takes. And so here's the thing I realized. This guy was a family guy. He had 3 kids. In fact, his kids were training at my martial arts studio. We brought them down there to do that. He had this beautiful home. He did the show. He was this likable guy that had the gift of gab. He promised things that were amazing. He produced things to prove it. He produced some results for a period of time, just like every Ponzi scheme. The only way the Ponzi scheme falls apart is if they can't get more people to come in. It falls apart. It gets too big for them to manage. That's what happened with Bernie Madoff. And so I got caught. I got caught because I let some things happen. I let my emotions get involved. He painted a vision, and I liked the vision, and I thought, this is great. And so I ignored my rules. Now, through that process of wiping out 1/3 of everything I own, now, mind you, we recovered what we lost within 18 months using the principles that I teach. They took the money, but they didn't take the skills. They didn't take the principles. Now, what I had to do is navigate the mindset, navigate the way I was interpreting, the meaning I was giving to it. And we talked a bit about this in one of our earlier lives, where we were talking about I had to first get acceptance. I had to accept the fact that I was responsible for the choices I was making that put me in that position in the first place. And when I was responsible, once I took the responsibility for it, I had the ability to make new decisions. But it's not just the acceptance that matters. It's the acknowledgement and the digging to figure out what the lessons are in the game. And through that Ponzi scheme, many of my new rules of investing have come into play. The things that I do today, the way I look at investments, the way I evaluate them, all of that is because of what happened in 2005. Absolutely no. It is why I do what I do. Because here's what I know. In that Ponzi scheme, I said there was me and two buddies, but there was more people in it. And there was people that lost their livelihood, they lost their retirement, they lost their homes. And some of them were old enough that they didn't have the time to recover like I did. And that's one of the reasons I testified. That's one of the reasons I helped them go after him, because I said, if this was my parents, they would have been devastated. I had a chance to recover. I had the skills to recover. I had the tools to recover. I just needed to get the mind right to recover and get the rules in place so it doesn't happen again. And so it's tragic, but I want to make sure that everyone here has control, 100% control of their financial destiny, their financial decisions. We can't control the market. We can't control everything. However, we can control our response to it, and we can control the decisions we make in response to anything that's going on. We can take control in the sense of how we look at things, how we decide things, who we work with. All of those things are within our control. We all have choice, and that choice matters. And so that's how I wanted to kind of just pre-frame this, because we're all going to make bad decisions at times. I'm still going to make bad decisions. I'm going to make some bum investments, I'm sure. But I know that when we follow a set of rules, the exposure that I have to loss, the risk that I'm taking is far less than what I took before. I'm not going to lose 1/3 of my net worth because I'm not going to put it at risk in that way again. Can I lose? Yeah. Will I be happy? No. Hell no. Who's happy with losing? Do I understand that it's part of the investing game? Certainly do. Did I put things in place, or do I put things in place to protect me from having substantial losses? Absolutely. Do I discern and take a critical look at an investment before I go in? For sure. Okay? So here's some things. I want to start off by talking about what are the things that cause people to lose money, because I think that there's some things that happen that cause people to lose money, and they're common if we're not careful. And so we need to understand. The first is this, is that they have no strategy. Let's just go back to this whole idea of GameStop. Okay, I don't know if you remember that whole thing. There's a bunch of people on Reddit were talking about GameStop and AMC and all that. And because of the talk, what ends up happening is that they start driving the price up, and people are buying and the price drives up. And what they were doing is they were actually trying to go after the short sellers in the hedge funds to try and take it out of their pockets. And so But there was a lot of people that jumped on that bandwagon that aren't educated in investing. They don't understand it. They just got caught in the tide. But here's what happened. Because they have no strategy. They have no fundamental foundation. When the tide reversed, there was a lot of people that got hurt again. So one of the reasons people lose money is they just go without a strategy. When we create in the affluence blueprint, when we start to create an affluence vision, and with advisors, when we're creating a strategic investment plan, there is a strategy involved to fit a plan, to fit a risk profile, to fit your risk tolerance, to fit your circumstances, to accomplish something. We have something, and if the investment doesn't fit in, it doesn't get in. Does that make sense? Hopefully that makes sense. So one of the things that happens is that people trade or they invest with no strategy. The second reason that people will lose money is they get poor advice. Okay, they get poor advice. Now this could be from advisors, but more likely they're listening to news and they're listening to gossip. They're listening to news and they're listening to gossip. You know, they're out there watering the lawn. I don't know if anyone does that anymore. They're watering the lawn. So I remember, so my uncle, for a little while was living at my parents' place, and he had a car and everything, and my brother and I'm an identical twin. My brother and I were 13 years old, and my mom's out there watering the lawn. And my neighbor, Mary, watering the lawn. And they're chatting. And Mary says to my mom, "How long have the boys been driving?" And my mom looks at her and goes, "Driving? They're only 13 years old. What do you mean driving?" And Mary says, "I see them taking their uncle's car out for a ride all the time." So she gave us up. We got caught taking my uncle's car out at 13 years old. My point is this is what happens with investment advice. A lot of times we're at a party and we get an investment tip. We're talking to the neighbor. We're watering the lawn and say, "Hey, I got in this great investment. This is how I got into the Ponzi scheme." What ended up happening is that a buddy of mine turned around and says, "I've been in this thing and it's been going well. You ought to check it out." And we listen to gossip and we listen to poor advice and we don't go through an evaluation or any kind of what we call due diligence to kick the tires and make sure that we're checking under the hood. And is it legit? Is it proper? Is it good? Does it have a real history? And we get burned. We get burned big time. That's what happened to me. Okay, the other reason people lose money is no consistency. No consistency. Those that will invest over time consistently will build wealth. Okay? Will build wealth. Remember I said $200 a month over 30 years at 8% turns into over $300,000. $1,500 a month at 8% over 30 years is going to be in the millions. Okay? But if you invest $200 here and then $200 there, or $1,500 this year and $1,500 10 years from now, it's not going to create the money and momentum you need to truly build wealth. Consistency is the key. And what ends up happening is, look, the market is going to go up and down in the short term. In the long term, the market typically goes up. When you look at the market over a 10-year period, any rolling 10-year period, any rolling long-term period, this is why we look at it and we say, when you're looking at short-term money, 5 years or less, we don't want to put it at risk. Anything that you don't need for over 5 years, then we can take it and put it in the market because the level of growth typically goes up in the long term. My point being is that we need to be consistent. So that's the third reason people lose money. Number 4 The fourth reason people lose money, okay, is no discipline. No discipline. In other words, and this is what happened to me, okay, have a set of rules. Follow the rules. Understand the principles. Follow the principles. Principles are fundamental, universal truths. Principles are a system of behavior. We follow them without question. Because they're infallible when they're principles. Okay? 2 + 2 does equal 4. It's a fact. Okay? But we need to have discipline. That means that we need to check our emotions. Okay? That means that I got to look at my list and checklist and say, does it satisfy everything that it needs to satisfy before I say yes to that investment? Discipline will save you more times than not. Discipline will keep you from making a bad decision. Now, is it possible that you might be over-disciplined and every once in a while leave a good investment behind? Certainly is. Certainly is. But you know what? I'd rather leave a good investment behind every once in a while than end up in a bunch of bad investments because I had no discipline. You know, I'm on a pension. I sit on a board of one of the boards of directors I sit on. I also am on their pension committee. We're running a fund of in excess of $30 million. Okay. Well, every month we meet. We look at the assets, we look at the investments, and we kick the tires. We look at the performance, we look at the manager, we look at the holdings. We go through with discipline because this is people's retirement. It's a pension plan. We need to know that we're taking care of the people that are beneficiaries of that pension plan. So we are disciplined to the T. We follow the rules of everything that we do. Number 5. Okay, number 5 is following the news. Forget CNBC, forget Fox, forget CNN, forget all of the media BS, pardon the expression, but it is BS and crap that they're feeding you because it's too late. By the time it hits the news wires, it's already in the value of the investment. And now this is personal, bent, I'm sorry, but you're going to get it from me anyways. What are most of these media stations in the business of doing? Giving us news, unbiased, objective data, so we can make some critical thinking decisions ourselves? I don't think so. That's just my opinion. I think they're there to get ratings. I think that they're there to sell ads. I think that they're there, yeah, exactly. I think that they're to get eyeballs. And the way they get eyeballs is to polarize situations. The way they get eyeballs is to sensationalize things. The way they get eyeballs is to air dirty laundry and rumor and conjecture. I don't care. The fact of the matter is that just like with investments, I'm not going to pull my investment advice from the media. I'm going to do an objective evaluation. I'm going to use critical thinking. We're going to use principles and we're going to use rules to see if they are right. We don't follow the news. It's too late by that time. And then the last reason people will lose money in the market is they have no safety net. Okay. Now this may get a little technical here, but when we talk about buying a stock, the idea is that we buy the stock, it goes up, and we can sell the stock and we make money. But what happens if the stock goes down? What happens if the stock goes down? Well, you got to sell it. But if you're not watching the market, you can't sell it. And all of a sudden, it tanks. And you get hurt. You lose a lot more. There are things in there that you can put where you say, look, I bought the stock for $10. I think it's going to go to $40. Okay? So I buy it for 10. I think it's going to go to 40. But I don't want to lose too much. So I put what's called a stop loss in at $9. So if it loses 10% of its value, it goes from 10 to 9, automatically I get out of the stock. It sells out from under me, I'm done. Okay? So I limited my losses by doing that. I put a safety net in at basically 10% in that case. I put a safety net in at $9. I bought it for 10. My worst case, I would lose typically $1. And so now I know what my worst case is, and I have a safety net. But those people that kind of look, mom, no hands, travel without a net, you stand to lose a lot more. In a fast-moving market, if bad news comes out or something happens with a stock and it tanks, you can't get out fast enough. You can't hit the sell button fast enough if fingers aren't on it. So we put it in there. So I won't buy a stock. I won't buy a stock without putting a stop loss in a second after buying it. We put a safety nets in to make that happen. Okay. So those are the reasons that people will lose money. And I'm going to give you my 8 rules. But let's go back through them again. First is no strategy. They lack a strategy. Second is that poor advice, gossip type of advice, or listen to the neighbor. The third is that there's no consistency in their investing. Fourth is no discipline. Fifth is that they're following news. And sixth is that they are working without a net, that there's no safety net. All right, so what are the 8 rules of investing that I use? Now, I have more than these, but fundamentally what I want you to do, this is the foundational rules first that I look at that we need to start with, okay? And then the first thing is, especially when you're starting out, rule number one is that you can't, I want you to not buy individual stocks. I know some people will say, but Mel, I got this tip on a stock. First off, the tip on the stock is gossip. Okay? But why don't I want you, if you're just starting out, I do not want you buying individual stocks. The reason for that is you put too much in one basket. There's too much risk involved with doing that. Now, do I own individual stocks? Absolutely I do. Do they make up the majority of my portfolio? No, they don't. But I bought them at a time, once I had a foundation of investments, a foundation of wealth, and then I took a slice of it and said, these are for my individual stocks. This is for my other stuff. Okay? So number one is to make sure that first, when you start out, you steer clear of individual stocks. We can get to them later. So what am I saying? I'm saying I want you to go into index funds. I want you to go into ETFs or mutual funds. I want you to go into a basket of stocks. The diversification will reduce your risk. If one stock goes bad on you or has a bad year or something, then all of a sudden you're not hurt as badly. Okay? If you look at something like Facebook, okay, as an individual stock, Facebook can actually move $10 in a day. Now, it's currently right around $300. It can drop $20. It can drop $10. It can drop $15. It can drop 10% in a day. If that's your only holding, it's too much risk exposure. Now, if it's your only single stock, but you have a whole portfolio of other investments, then it's not a big deal in the picture of the whole portfolio. This goes to asset allocation and asset diversification when we start to look at that. So that's number one. Okay, so the first thing is to make sure that no individual stocks. Number two is that we want to make sure, I don't know why I didn't bring my iPad up on that, but we'll try that again. So number 2 is this. I want you to keep it simple. Keep it simple. Now, what do you mean by that? There's two things to meaning keeping it simple. I don't want you to ever invest in anything that you do not understand. Okay? I don't want you to get into complex investments. There are things that I'm invested in, but I didn't start there. There are complex capital structures, complex investment structures, but I understand them. In fact, before I invest in anything, first, so bottom line is, if anyone comes to me to bring me an investment, I don't even have a conversation with them, okay? Because I don't take anything that hasn't been vetted 3 times before it comes to me. So someone says, I got a stock tip, I got an investment, not interested, okay? Not interested. So my investment guy, my wealth strategist, before he ever shows me an investment, a couple things happens. It's vetted by his broker-dealer. It's vetted by him. He flies out, meets with him, kicks the tires. Then when he comes back and says, I kind of like this for you, Mel, you want to take a look at it? Let me explain it to you. He explains it to me, and I say, great. Get me on the phone with the vice president. Get me on the phone with their top guys. I want to have a conversation with them. And I then kick the tires. And if I wanted to, I could get on a plane and fly out there and meet with them and kick the tires. Bottom line is this. I'm going to make sure that I check it 3-4 different ways for legitimacy, for all the risks and all the things, and I'll read through the documentation. And I know that's a lot of work, but you know what? Here's the question. We're talking about your future. We're talking about your legacy. We're talking about your financial independence, your financial liberation, your ability to live freely with peace of mind. Isn't it worth the investment of your time to make sure it's right? So you don't lose 1/3 of everything you own like I did? Okay. So I want you to keep it simple. I want you to make sure you understand it. If you don't have an understanding of stock investing or real estate investing or whatever it is, we need to build that understanding. That's partly why you're here. That's partly why we have the show that's coming out. Okay? But there's books, there's programs, there's other podcasts and stuff. It's important that you get involved. Now you might look at it and go, but I'm not a numbers person and investments seem complicated. Well, if they seem complicated to you, then you don't understand them enough to invest in them. So let's start simple. A simple ETF that tracks the market. So what an ETF is, or an index fund, is basically saying, look, there's the S&P 500, which is the big companies, okay? 500 companies, the S&P 500 companies. You don't have the ability to sit back and invest in all of them unless you have a substantial net worth. But you can invest in what they call an index fund, a fund of these companies where you take a little slice of it. And now it tracks the market, okay? There's different index funds. I just picked S&P 500. You can get a broad-based index fund. You can get real estate index funds. You can get all kinds of things. But what's happening is that there are people that are making sure that it's tracking the market. It's easier to understand, and it satisfies some of the other rules that we have when we start looking at fund type of investing, which is what I'm talking about right here. Okay, number three is don't follow the crowd. Okay, this goes back to listening to the news and making your decision based on that. Don't follow the crowd, meaning that I want you to make independent decisions. Here's the thing. A lot of people will say, Mel, what are you investing in these days? And the problem is, what I'm investing in is good for me. It's good for me at my age, my circumstances, my level of wealth, my level of financial understanding. It may not be good for you. So what I'm investing in is not meaningful at all. It's what you should be investing in. what works for your circumstances, your situation, your level of wealth, your level of understanding, your level of wisdom. As you expand your financial comfort zone, your financial information zone, you have the ability to start investing in more complex things. So what we need to do is not just follow the crowd. Just because your neighbor, your buddy, your friend is doing certain investments doesn't mean it's right for you. There are a lot of investments that my son is in. He's 31. His wife's 27. Okay? That I'm not in. They're great for him. They're not good for us. Okay? They're great for him. They're not good for us. So it's important for you to understand that we don't follow the crowd. We're going to make independent decisions. Okay? Next one. Next rule. So this is rule number 3. Rule number 4. Rule number 4 is keep expenses low. Okay? When you invest in things, there's expenses associated with it. There's costs to manage it and that type of thing. And those costs eat into your returns. So you want to, index funds and ETF funds have lower expenses, and you're going to want to make sure that you have those expenses as low as possible. So I'm constantly looking to see, how can I reduce the expenses? Because if I can reduce the expenses on me, that's going to automatically start to increase the returns to me. So we don't want to pay high expenses if we don't need to. So we want to look for low-cost funds, low-cost situation. So we're not in a situation. I just want to look at something here that we're spending a lot of money on expenses that don't make sense. Okay, so we want low expenses. That's rule number 4. Rule number 5. Rule number 5 is don't time the market. Okay? This is an interesting one. So especially now. If we think about it, if we think about the market, it goes up and down. Okay? And it's been shown, statistically it's been shown, study after study after study, that it is impossible to truly time the market. Okay? In other words, to know specifically that it's at a top. People are saying, is it a bubble, Mel? Is it going to burst? And my answer is, I don't know if it's a bubble. Is it going to correct? Is it going to go down? Yeah, it is going to go down. Really? When? I don't know. But what goes up comes down and goes back up again. That's what the market does. I just don't know when, and I don't know how much. So I'm not trying to time the market. Okay? Time the market. Trying to time the market is a fool's game. Here's the thing that builds wealth. Not timing the market. Time in the market. In other words, we get in the market, we stay in the market. We get in, we stay in, we keep going. Over time. See, in the short term, we may have a lot of volatility. Think about what happened in March of last year. Market dropped 30%. And a lot of people freaked out, panicked, and got out of the market. And guess what they did? They locked in the 30% loss. But those that stayed in the market and said, well, let's see where it goes, okay? They not only recovered, they had a banner year. They had a good year last year. So we're not trying to time the market. We don't time the market. We don't go in and sit back and say, well, I think it's at a peak. It's time to sell. Or, that. And here's the other side of this, because it bears having a conversation around this. There's a difference between investing and trading. Trading, you're going in and out, in and out, in and out. Investing is long-term. Investing is staying in the game for the long term. Okay? I got a stock in my portfolio. It's one of my single stocks that I own. I got into it at $15 a share. $15 a share. I was in it with a couple of other people. It went up. Went up to $80, went up to $90, went up to $100. Then it came back down to $80, down to $70, back up to $85. My friends got out because of the volatility in the short term. I stayed in. Do you know today it's well over $300? 380 or so. You play the long-term game. I don't time the market. And everything. So we get in the game, we stay in the game. Which leads me to rule number 6. Rule number 6 is to think long-term. Long-term. This is a long-term game. Wealth building. Think about this. The idea of compound, the compound effect of investing, the money momentum effect of investing is an exponential curve. It's like a hockey stick, okay? It starts flat, and then it starts to grow, and then it grows at a faster pace. Well, that means that we need time on our side. I got to get in the market, and I got to stay in the market so I can get to the accelerated growth part of it. That's why we get in, we play the long-term game. I want you thinking 10 years and beyond. Now, there will be things that you do in 5 years and 3 years and 1 year. But when you're talking about wealth, when we're talking about true wealth, we're talking about affluence and financial liberation, it's a long-term game. It's a 10-year or more game to really start to see how the mathematics work for us. Okay? Time does the heavy lifting because of the compounded effect of it. Okay? Then, number 7. Okay, number 7. No emotions. Oh my God, this is a big one. No emotions. Okay? Here's the thing. The higher your emotions are when you're making financial decisions, the lower your financial intellect is. When we start making emotional decisions, and this is what caught me in the Ponzi scheme, was I got emotional about it. I got emotionally attached about the possibility of a 20% rate of return in 6 weeks. And I looked at it and I said, oh my God, this could be great. And all of a sudden I could envision, the house is paid off and I can get this new car and I don't have to work and I can do this. And all of a sudden my emotions got involved and my brain went out of my head. And I lost over 7 figures. Sorry, I got emotional. Sorry about that. But I'm not supposed to get emotional. So here's the deal. When you start to feel like your emotions are getting involved in a financial decision, you better check yourself. Because the higher those emotions, I hate to say it, a lot of times the dumber the decision we're going to make is. Okay? I lived it in a big way. Okay? So our emotions get in our way. We need to, and this is why it's important for us to look at things in a certain way and say, does this satisfy? Does this make sense? Because if it doesn't make sense, then and what we're getting, they're pulling our emotions in. And someone that's a salesperson understands how to take the emotional strings. So, and most of you are entrepreneurs on here. You're entrepreneurs. You know how marketing works and taking the emotional strings. We don't do that. Your financial decisions are non-emotional decisions. They are mathematical, they are analytical, they are disciplined, and they are without emotion. Okay? This is the same thing. I can tell. I had a good friend of mine who asked me, I do a lot in helping people with negotiating because of my negotiating. In fact, Lori brought that up. I do a lot of negotiating. And I had a friend that wanted to buy a building. He says, would you help me negotiate the building? And I said, yeah. I said, what's your walkaway price? He goes, oh no, I want it. I said, no. Tell me when you'd be willing to walk away. He says, I said, if you don't have a walkaway price, you're screwed. You're screwed. It's a problem. Because if the other side feels that you're so emotionally connected to that buy, they have you over a barrel. They've got the leverage on you. When we bought our house, this could have got me in a whole heap of trouble. Okay? When we bought our house, it was a Friday when the deal was put on the table. And the other side, the seller came to me and said, here's the deal. I've got people coming in over the weekend, and so here's my bottom line offer. And if you don't want to accept it, totally fine. Now, this was in the morning on Friday. If you don't want to accept it, totally fine. We'll go into the weekend. There's going to be more buyers. And so he's playing on my emotions, saying, oh my God, I'm going to lose the deal. I'm going to lose the deal. I'm going to lose the deal. So I told my realtor, and I said, here's what I want you to do. And he said, what? I said, you need to do this exactly as I'm telling you to do it. And he said, what? I said, I want you to call him up. I want you to send him a counteroffer and say, here's the final and best offer. But I want you to tell him this. We've looked at 3 homes in that community, which we did. And I said, his is at the top of the list. We want his home, but we're not so tied to it that we're going to overpay for it. So here's the deal. Here's my final and best offer. And either he accepts it or we take the next one on the list because we have an offer ready to go for that one. So it's up to him, but here's the bottom line. Today, on Friday, we're going to get a closed, not a closed deal, but we're going to get an accepted deal on one of the 3 homes in this community. We want it to be his, but if he doesn't want it, totally fine. He's got 3 hours to accept the deal. And like my realtor's saying, 3 hours, we usually give them till the end of the next day. I said, nope. He wanted to play the game with me, that he wanted to go into the weekend. He's not even going to get to the weekend. So by dinner time tonight, he needs to either accept or reject the offer. Accept or reject the offer by dinner time tonight. Otherwise, we move on. Okay? So that evening, we're getting texts from the seller. He's on his way to a father-daughter dance going, tell him we're accepting the offer, but I can't sign it because I'm on the way to a father-daughter dance. So we got the deal. We got the deal because I didn't allow the emotions to come in. Now, my realtor came back to me and says, that was a risky deal, a risky way to do it. And he said, what was Stephanie saying when you told her you were going to do that? I said, I didn't tell her I was going to do that because her emotions were involved. He says, oh, she would have shot you if you lost the deal. And I said, oh yeah. But here's the other thing I know. I wouldn't have lost the deal because I could have always gone back to him. So bottom line is we don't allow financial decisions to be made with emotions. We make them with logic, with analysis, and all that. So that's the way we make it. And then when we look at number 8, and number 8 is that we have a system or a process that I take people through called the 6-factor evaluation. It's really just looking at expenses and growth ratios and everything that I take them through in the Affluence Blueprint. But the point being is that have a system to evaluate an investment. In other words, you want expenses to be less than 0.5%, if that's what it is. You want a 10-year growth rate of continual growth rate for the fund. You want a manager that's been in the fund for at least 5 years. You want whatever the criteria is for you. You want dividend growth or dividends, existing dividends. If you're looking at there's a way to invest in dividend yielding stocks. You want a history, a 10-year history of dividend yields going up. So there's a bunch of ratios, which really would be meaningless for me to give to you right now, unless we got deeper into the whole stocks and everything. But when I look at investments, there are criteria for each one. And I go, it's simply yes or no. It's binary. Either it is or it isn't. And if it isn't, it's not an investment for me. It shouldn't be an investment for you. We need to know what that is. We need to look at that and say, look, if I'm going to invest in a mutual fund, I want it to have, I'm just arbitrarily throwing this out there. So don't take it as this is Mel's system or Mel's way of doing things. And in fact, I probably should caveat this and say I'm not giving any investment advice here. Okay? That's my CYA, not giving any investment advice. But here's the deal. I might look at it and say, I want a 10-year history of continued growth in value. Okay, I want a 10-year history, or a 5-year minimum history on the manager. In other words, if there's a turnover of managers that are managing the fund, things can shift. I don't want that. I want to make sure that there's continuity in the managers. I want to look at it and make sure that I don't have high expenses. Okay, so I want to make sure that there's not high expenses. I typically, if I'm going in ETFs and index funds, I want them below 0.5%. Because that over time adds up to a lot. What some of the other things that we'll look at is turnover. Okay, especially with this possibility of this increase in taxes that might be coming our way. Duck your heads, people, because I don't care what they say. I don't care what they say about, oh, it's only for the wealthy. Hell no. It is going to hit every single one of us if they increase taxes. Okay? It will hit every single one of us. Promise you this. Whether directly or indirectly. Because let's face it, if a corporation has to pay more taxes, who do you think they're passing that on to in pricing? If they take away the capital gains rate and double it like they're talking about, guess what? If you sell a stock or you sell something at a gain, you're going to pay the same high rate too. So it's going to affect everyone. I don't care what they're saying. This is the kind of media BS that's out there. Do some critical thinking. Really understand. Now, we won't know exactly what it is. Sorry, I went off on a tangent. Okay? But I think it's important that we understand the game we're in. So the turnover, why I said that is this. A mutual fund or a fund, the mutual fund owns stocks. And every time they buy and sell a stock in that basket, it creates a taxable transaction that gets passed on to you. So if it's got a high turnover rate, all of a sudden you've got higher taxes because they're turning over the portfolio too much. This may be a little bit more complicated or technical for some that aren't used to it, but just know that I'll look at turnover rates. So point being is this. You all need to have the checklist that will be the binary checklist of yes or no before you go into the investment. Here's the other side of this. When you go into an investment, whether it's real estate, whether it's stock, whether it's annuity, the thing that you need to have defined is also the criteria for getting out of the investment. In other words, when I go into an investment, I know what my exit is. I know how I'm going to get out. I know what's going to cause me to get out. I know why I'm going to get out. Because if we don't do that, here's what happens. And I've watched it happen over and over and over again. We get into an investment. The investment, we say, I'm just going to go in this because I'm going to go into the investment. I'm going to pick a stock. I don't care. Let's just pick on Apple a little bit. Okay. So I'm going to buy Apple and I'm going to buy Apple. I'm going to hold it for 2 weeks because their earnings are going to come out in 2 weeks. And I believe that their iPhone 12 and their new iPad, I think that the sales are up, and I think that the stock is going to go up because when they announce earnings, it's going to be their outlook is going to be good. So you're surmising it, and you said, I'm going to be in it for 2 weeks. And so I'll be in it for 2 weeks and then I'll sell. That's what you said going into the investment. Here's what some people do. All of a sudden, they go into it for that 2 week period. They know what their exit is. But now when they announce earnings, the stock price goes down. And so what ends up happening is they change their mind and say, well, I'm not in it for 2 weeks. I'm now going to be in it long term. And you start changing the criteria. That's why it's important to understand your criteria going in and coming out. It's important to do that. Listen, okay, this is somewhat, I guess it's personal. You'll know a little bit about me personally. Look, I got married to Stephanie. We will hit, in June, we will hit 10 years. So I'll be 60 this year. So I was 50 years old when I got married. But I said to myself, I have a dear, dear gal who has worked with me, Donna, since 1990. She's been with me for that long. And since 1990, she's been with me that long. And 3 years after she started working with me, her husband slid out on a motorcycle and ended up paralyzed from the chest down. He was on the dirt. No one hit him. It was a freak accident. And I just remember sitting with Donna. You know, and they're still together today, and she still works with me today, decades later. I remember sitting down with Donna and saying, "Yeah, I give you a lot of credit." And she said, "What do you mean?" And I said, "You stuck by Ron, even though you got the life that you didn't bargain for." And she goes, "But that's what marriage is. For better or for worse. That's what it is." And I knew then that I had my criteria for getting married. That I swore to myself that I would not get married until I met my Donna. Well, I met my Donna with my Stephanie. Okay? And she's proven it over and over again, especially in the last 2 years with the cancer, but over and over, well before that. The bottom line is this, and this is no different than investing. There are things that need to be in your checklist, if you will, that are criteria, that are non-negotiable. And we need to know that before we get in the game. We don't try to make sense of an investment while we're in the investment, because that's when our emotions come in. Because all of a sudden, you're losing, you might be losing, this and that. Listen, we make emotional financial decisions. It's a mistake. You're going to get hurt sooner or later, okay? So it is important to make sure that you have that dialed in. So those are the 8 rules of investing. These are the foundational rules, and then depending on whether it's real estate or investments or in stocks, we look at things differently. But these are the things that will keep you from getting yourself hurt. You now know the 6 things that cause people to lose money. You now know the 8 rules for investing, and then we're going to talk a bit in the next session about the priority, what I call the wealth priority ladder, to talk about that. So with that, let's do this. Let me answer some questions. All right, let's see what we've got coming in and everything. I can't believe we're day number 7. Wow, going fast. All right, so let's see. Salima, what does she say? What percentage of your total portfolio would be in good to have in real estate investments, excluding your personal residence? Well, here's a great question. The answer is it depends. And I'm going to tell you why. I have real estate investments, but do I own a lot of properties, units? Nope, I don't. And the reason I don't is because I don't like being a landlord. I'm not waiting for the phone call at 11 o'clock and I go, "Hey, toilet's clogged. Come get a dang plunger." I don't know. So I own real estate investments via real estate investment trust. I do own property, different properties and rental properties, but it's not a huge part of my portfolio. Now, let me contrast that with my dear friend who I was just on the phone with, James Wedmore. He's got multiple properties because he loves real estate. It fits his lifestyle. See, we're not stuck with just one type of investment. So the real question is, what's right for you? If you want to be a landlord, if you want to be a property owner, then by all means you can put that in there and you can diversify the portfolio. Now here's the bigger thing. is that when we talk about a portfolio of investments, we want to make sure that you've got an asset allocation that gives you some diversification. So you might have a portion in stocks, you might have a portion in real estate, and you might have a portion in alternative investments, you might have a portion in annuities. So you have this diversified portfolio. The percentage of each of those things changes the risk profile of the portfolio. You might have a little percentage in cryptocurrency. The percentage that you have changes the risk profile of the portfolio. And the risk profile of the portfolio is dependent upon you and your personal circumstances. Okay? So I do know some people that are primarily real estate. They probably have 70% of their wealth in real estate, but not one property, multiple properties. So they diversified the real estate into multi-unit, into duplexes, into single-family residences. And they have in Airbnbs, they have a lot of assets in real estate, and it works for them. And it could work for you, Salima. It just depends on your personal situation. But at the same time, it's got to work for your lifestyle. In my case, I don't want a ton of real estate where I got to worry about managing it. Now, I can get a manager and do all of that. But I found that I could get real estate returns in other investments without taking on the responsibility and the burden of being a landlord. So I hope that helps. I know I didn't give you a specific percentage because it doesn't. I don't have one for you. I can't tell because what's right for me is different for you. But what we need to do is look at it in the totality of all your assets to see, does it make sense or does it raise the risk too high at the when you're looking at your risk profile. Okay. Oh, Ann, thank you. Oh, awesome, Julia. All right, so let's see. Mark's got thoughts on evaluating potential financial advisor firms as well as professionals at the firm. Wow, this is a great question, Mark. So here's the thing. Not all advisors are created equal. You have people that are financial planners, which primarily do planning. You have brokers, which primarily do sales. You have fiduciaries, which are the ones that I typically will recommend. Because most everyone, and then you have glorified insurance salespeople. And if I've got insurance salespeople on here, I'm sorry, but they're glorified, they're insurance salespeople and they say it's financial planning. But they're there to sell you insurance products. Insurance products are for insurance. They're not for investment. That's my opinion. Okay. And I know I'll get pushback from insurance people because there's a bias there. They want to sell an insurance product. Okay. You have a better likelihood to make better investments than the insurance company does because they're going to cut a ton of expenses through it and not make it. So I steer clear of brokers. I steer clear of insurance salespeople. Okay. I'll work with planners and fiduciaries. And why a fiduciary? A fiduciary is someone that by their licensing requirements, absolutely they have a fiduciary responsibility to put your needs, your interests above all else. Put your interest above all else. In other words, if there are two investments and one will make the money, but is not as good for you as the one that won't make the money, they must give you the one that won't make you money. They need to do it in your business. Now, typically those are fee-based, so you're going to have to pay them a fee instead of commission-based or transaction-based. So it's important. I was working with a broker once, and he came to me and he sold me into an investment. This was years ago, okay? He sold me into it turned out to be an insurance product, but he called it something else. And what I found out after I left him is that that product, one, it wasn't a good fit for me, but I didn't have my rules and I didn't have my criteria at the time. Two, his brother was the rep on the investment, so him and his brother got a commission on it. Three, I had 6 days, 6 years down the line, 6 days, 6 years down the line to get out. And if I missed those 6 days, I was locked in for another 5 years. So we all had to put on our calendar those 6 days, so we made sure we got out and got rid of it. I want to know that the only bias my advisor has is for my own success, and is willing to have hard conversations with me, because I will have hard conversations with them. Now, there's 3 other things that I look at for them. One, they need to get your vision, your dream, your affluence vision. In other words, they're not there to tell you why you can't build this. I just had a conversation with someone, and they're looking at their numbers, and they say, this is what we want. And they looked at me on the Zoom call and they said, is that silly? No, it's not. Our job is to make it happen, not to tell you you're silly. So let's figure out how we're going to make it happen. I can tell you how the numbers work out, and I'll tell you what you need to do to make it happen. And then you can sit back and decide whether you want to do the work or not. A fiduciary, an advisor's role is to help you fulfill your vision, not to tell you why you can't. Okay? So the first thing you got to do is buy into your vision. The second characteristic they got to have is they have to have the heart of a teacher. They are not there to make financial decisions for you. They are there to guide you, to inform you, to educate you. Remember, I said we don't invest in anything that we do not understand. And in order to understand things, they need to explain them. And if the advisor has to explain them 3 times, 4 times, 5 times, they better have the heart to do it, because that's their job. So you can make an informed decision. If they're not patient enough, or they're talking down to you, and they're not willing to take the time to make sure that you are truly educated and informed, they're the wrong person. And the third is they have to have the soul of a servant. I don't want someone that sits up and thinks that they know everything. They're there to serve my dreams. They're there to serve my vision. They're there to help me lead from a servant place. And I don't mean it in any negative way, but in a place where they are there to stand by my side and point out the things and educate me and give me the opportunities. And so if they don't have, I don't care what their designations are, I don't care what their licenses are, I don't care about any of it. If they don't have those 3 characteristics, I'm out. And the other thing, at least with mine, I tell them that I want to meet virtually or in person. Now, before the COVID, we did it in person. At least quarterly. And if you have a problem with that, you let me know, because I'll find someone else. I want to have a call, probably once a month. When you don't need it when your portfolio isn't large, but at some point it's going to grow. And what I need someone that is a team player, that's willing to do that. And I want someone that's going to be proactive. I don't need them calling me up after an investment goes bad and say, hey man, that didn't work out so well. I want someone that's checking the pulse on all the investments. And so I sit back and I said, let's make sure, Mitch, that you're looking at every one of my investments at least once a month. Now, I don't mean look at it. I mean analyze it. I mean look at, did anything change? Is there a reason we should get out? Are there things? I said, I want us to be proactive, no different than what I do on the pension committee. Are there changes that need to be made today? We don't wait till the end of the year. We don't do it once a year. This is your future. This is your children's future. This is your grandchildren's future. This is your legacy. Mark, you got me going. I'm sorry. So that's the way I look at it. And how do you find a fiduciary financial advisor? So if you just do a search in your area for fiduciaries, they will come up. Just look up fiduciary financial advisors. They'll say that they're a fiduciary, and they've got the designations, and then go through and really critically interview them. I would look at 3 or 4 of them, before I make a decision, and be critical. Ask hard questions. Here's the other question I ask. I want to know what they're invested in, because you know what? If they wouldn't put their family's money into the things that they're recommending, okay, why are you going to recommend them for me then? The other thing that I look at is, how successful are they? I was looking at an old investment advisor that I used years ago. And this is going to sound judgmental, and maybe it is, okay? Years ago. And I happen to know that he made, this year, like $90,000. He wasn't that successful. I need to know that my advisors understand where we're at, where we're going, and that they have the sophistication, the understanding, and the success in their own world to make it happen. Okay? So hopefully, that was a long-winded answer to it, but hopefully that helps. Okay? I'm considering using Questrade here in Canada to start some other investments. What are your thoughts about these types of businesses? Do you require more investment knowledge than they advertise? I'm not familiar too much with Questrade, but if it's just a robo-advisor type of a thing, then you're going to need to do a fair amount of your own research on investment advising. Here's the thing. You're going to have people that are going to get, and accounts are going to give you access to buying and selling investments. But that doesn't mean that they're going to give you access to advisors and planners that will take and look at an individualized plan. Remember, we said early on, not an income-based plan, but a lifestyle-based plan to make it happen. So depending on where you're at, Ann, I think it's important for us to make or Julia, to make sure that you're getting the skills and the tools you need. If you need someone that's going to help you put together a lifestyle financial plan based upon your vision that's properly done, and then help you execute on that plan, then a robo-advisor may not be the right place to go. If you're looking to just get into, I just want to start, I'm going to buy into a broad-based ETF or index fund, you can do it through a robo-advisor just the same. But when you start to get into complexities that involve trying to build a long-term plan and tracking it and that type of thing, you're going to want something a bit more sophisticated than that. So, hope that helps. Cool. Other questions? Man, we've been rocking and rolling. This has been the longest one yet, but it has been fun. Cool. All right. So remember, okay. Oh, new message. Let's see what's there. What's the best and worst financial advice you have ever received? Oh my gosh. Let's see the best financial advice. I think the best, that's a really good question. I think the best financial advice that I've received really is around, I'm trying to think of exactly how they said it, but basically, bottom line is this, is that leaving a gain on the table is better than taking a loss off the table. Okay, in other words, I'd rather not be in an investment and lose out on opportunity than be in an investment too long and lose actual money. So sometimes I might get out a little early. Sometimes I might get in a little late. That's okay. I'm not trying to time the market. Okay, so that's probably one of the best advice because it takes the emotion out and it gives you permission to sit back and go, look, because I don't care. Like, I've been in and out of cryptocurrency a couple times, okay? And here's the challenge. I got out at one point. I made a fair amount of money. I got out. It went down, and then it rocketed up, and it rocketed up without me. Okay. Now I could have felt bad. I felt bad, beat myself up. But you just got to let it go. It's in the past, and the next investment decision has to be an independent investment decision from the last one. This is what I call the gambler's dilemma. What happens is that they lose a hand. Maybe they're playing blackjack and they lose a hand, so they double down on the next hand, thinking they got to make up for the last one. Bad move. Each investment decision is separate. If I screwed up and made a bad one in the last one, we don't carry that to this one and say, I got to make up for it. Because what's that? Your emotions getting involved. Okay? What advice would you give your children as they begin investing? Here's probably the best thing is, one, if you can get them to understand that just investing small amounts over time will turn into millions if they start young, it's important. I started paying my son at 11 years old. Now, in the U.S., if you pay a child under 18 years old from a sole proprietorship, a Schedule C, you don't have to pay Social Security tax on it, and you don't have to pay SDI. Now, they've got to perform some services, and you got to pay them market wage for those services. So I would pay Jeremy, a couple $100 a month or whatever it was, and from that, he paid for his lunches, he paid for some of his clothes, he paid for some of his toys, he made some donations, he did some savings, and now we had the opportunity to talk about investing. Now, the easiest way, and this kind of goes against one of my 8 rules, but for the purposes of teaching a child about investing, one of the easiest things you can do is to have the child look at what they use and what they like. So, for instance, they might like Disneyland. And you go and say, would you like to own a piece of the mouse? Okay? And they go, what? You go, you can actually buy a piece of Disneyland. You can own a little piece of Disneyland. And literally, it's not a lot of money, and that's why I violate one of the 8 rules. But I think it teaches a child to understand. So we say, and now you can explain what a stock is. It's a certificate that says you own a little piece of Disneyland. Now, it doesn't mean you can go in for free and all of that stuff. And they said, let me show you how to buy it. And you open up the account, maybe a miner's account, and they have a little bit of money in it, and you show them how to execute a trade, and now they own Disney. And now you show them how to track Disney. Every week or every month, they can see what Disney's doing. And when Disney pays a dividend, the dividend comes into the account. All those things. And so I would do that to get them used to investing and looking and being aware of what's around them that is being used. Because trends are all around us. If people were thinking forward, and some were, at the beginning of last year when the pandemic hit, and thinking, oh my God, virtual meetings are going to be big. Maybe I should buy some stock in Zoom. Would have done pretty good. Okay? We need to look at what's happening right now, right in front of us. What are the products we're using on a regular basis? What are the products that people are using on a regular basis? Those kinds of things. So I would get them to understand the idea of this idea of financial independence. Do you want to be independent? Do you want to own some things? What does investing do? And start to teach them. You don't need to wait. I think you have these conversations early. Like I said, I started him at 10, 11 years old. Started having these conversations. And so that's how I would do it is if you're going to have a money date, like we said, do it with them too. When the account statement comes in, go through it with them. You're going to see them. They're going to get the kids, when they lose, all of a sudden, if the account goes down a little bit, they're not going to be happy, but you can have some really good conversations about it. Instead of what we do today, we don't talk about money. So that's how I would start. It's very, very basic, very simple. Have them understand that, just doing it regularly, because they'll see it. They'll see that if they're putting money away from their allowance. Never called it allowance. We called it a commission. So they're putting money away on a regular basis, and then it's growing, and they make an investment, and it grows, and it grows. All of a sudden, they see that it's going up. And it excites them, and now we can have more conversations. That's what I would do with the kids. I would start them early. So, all right. All right, y'all. It's Sunday night. All right, so here's the deal. We've been going for, oh my God, an hour and 15 minutes. But I love this. So here's the deal. Tomorrow morning, 8 a.m., new post, new prompt, new exercise. Do me a favor. Make sure that you are posting in the comments under the post, the exercises, because we're going to be doing a drawing on day number 10. Okay, we're going to be doing the giveaways on day number 10 and all that stuff. So make sure that you're in there, and you get an entry every time you're doing an exercise and posting in there. And do me a favor, share this out. Let's get it out there to folks. And know this is all about the Affluent Entrepreneur Show, coming to your computer, your tablet, your phone, wherever podcasts are sold, the week of May 3rd. So that's what this is all about. It's me celebrating with you, and let's just have some fun. So thank you so much for being here. Thank you for staying. All right? And I look forward to seeing you tomorrow. We'll talk soon. Cheers.